Hi, and welcome to another Coffee with Brendan. Today is January 27th, and two things are happening. One, stock market's down about 10% from its, year to date, so over a month time frame. And the other thing is it's playoff season for football. So today's topic is playing offense when everyone else is playing defense. And so what I'm going to do is I'm going to give you three ideas that you can consider when it comes to getting into the market or taking action during a time when the market has a big drop. So the first thing is pretty simple. Let's say that you had a stock that you had your eye on for some time, but it was just too expensive to have gotten into. Well, guess what? Now the market is down 10%. You could make the argument that the stock that was on your watch list is now on sale, and you could purchase it at this point. The market's down 10%, but there are some pretty big names out there that are Fortune 500 companies that are down, 25, 50, even 70%. That you could take a look at that just a few short months ago, you'd be paying a pretty significant premium to purchase those. So that's suggestion number one, is just simply buy something that's on sale right now. Number two is going to take a little bit more explaining. So let me open up a spreadsheet here. Let's say, and this is an actual pretty big stock that's in a lot of people's portfolios. Let's say that at the peak of the market, you purchased 100 shares of this specific stock, and that stock was trading at $700 per share. So you pretty much purchased $70,000 of that stock back in November 2021. Well, fast forward to this week on the 24th, and that share price has actually taken a 50% hit. But you still have that 100 shares, and so now the value of your investment has gone from $70,000 down to $35,000. So obviously, no one likes it when you lose $35,000. But one thing that you could do, especially if you're in one of the top tax brackets, is you could artificially trigger a tax loss, which ultimately leads to a tax deduction for most people, and sell it. You sell it today on January 24th. You book this $35,000 short-term loss because it's less than a year. And for a 40%, for a person in the 40% tax bracket, that could ultimately lead to a $14,000 tax savings. Now, this is just a temporary thing. You have to be out of the investment for a certain period of time per the IRS rules. But let's say that you get back into this thing back in February. So you get in February when the share price is even lower at $300 per share, and you buy back those 100 shares. So again, just the timeline of this, you bought 100 shares in November, you sold those 100 shares in January, and you bought them back in February. Now, the whole reason for this is to book this loss and get that on your tax return for the upcoming year. In addition to that, if the share price keeps going down from 350 down to 300, well, guess what? Now you're repurchasing that back at $30,000. You sold it for 35, so you made another $5,000 in that transaction. So the total impact to you could be almost $19,000 in that case. So you're using that tax loss as a potential benefit to you. Now, of course, the opposite is true as well. So let's say that instead of the share price going from 350 down to 300, instead goes from 350 to 400. Now you're buying it back at $40,000, and you lose $5,000 in that situation. So now your tax savings are a little bit more muted. You had the $14,000 of tax savings minus the loss of having to buy back at a higher price, but still a net benefit to you. So that's option number two. Option number three is something that that some of my more wealthy clients have always thought about, but it costs them money to do, and that is converting traditional IRA assets to Roth IRA assets. So real quick, traditional IRA, you typically get a tax deduction up front, and it grows tax deferred. And then at age 72, or whenever you take that money out, you have to pay tax on whatever money you take out of it. So you have a $50,000 traditional IRA, it grows to $100,000, and you take out $10,000 from there, well, you have to pay tax on that $10,000. Contrast that with a Roth IRA. Roth IRA, you don't get a tax deduction up front, but that $50,000, if it grows to $100,000, and then you take that $10,000 out, no tax. Now, again, there are some rules here that you need to take into consideration. We'll have that disclaimer to disclaim that. And obviously, when you're talking about any kind of tax situation, you want to make sure that you speak with a qualified tax advisor. But with all that out of the way, so let's say that you wanted to convert some of your tax deferred money to tax-free money, convert from traditional IRA to Roth IRA. Now, there's a good news, bad news situation with this. The good news is that, again, you're converting money from tax deferred to tax free. So you wipe out any future taxes on appreciation. So going back to our other example, let's say that 100 shares that you had goes from 350 back up to the 700,000. In a Roth IRA, that extra $35,000 of growth is tax free. That's great. So really good, pro to the Roth IRA. However, the con to doing this is that whatever you convert over, you actually have to pay tax on, and it's considered income. So again, let's go back to our old example here, the one that we just used. And let's say that, on the purchase date, on November 17th, you decide that you want to convert $70,000 of traditional IRA money to Roth IRA. Well, guess what? You actually have to add $70,000 to your income for that year and pay tax on it at whatever your tax rate is. For a lot of people, that's a pretty high hurdle. But let's say, again, share price has gone down 50%. You could convert that same 100 shares at half the cost. Because again, the Roth IRA conversion would happen on January 24th, when the value of the account is $35,000. The day that you the day that you make the conversion is when you lock in that dollar amount that you converted over. So in this case, you're saving, again, a ton of tax money to do this Roth IRA conversion that you always wanted to do, but you never could do because the value of your accounts were too high. So those are 3 quick ideas that you can think about. Obviously, a couple of these are tax related. So again, I'll reiterate, you always want to speak with a tax advisor on all this. And the other piece of it is we're always here. So feel free to pick up the phone, shoot us an email, and we can help walk you through this as well. So hopefully this was helpful, and we'll talk soon. Thank you.